Carol Roth, welcome back.
Hi, Glenn. What a crazy couple of days here. Never ceases to amaze, does it?
It really doesn't. First of all, let me get your reaction. We spoke on Friday on the Friday exclusive that I do for BlazeTV.
Yes.
And this story was just breaking.
Correct.
So they bailed everything out with the FDIC, but this isn't just the depositors that they bailed out. I'm for FDIC covering depositors, but they just changed the law with a stroke of a pen, did they not? I mean, you had $400 million in that bank. It says clearly on the door, deposits up to $250,000.
Yeah, it's funny. I have a different take on this than a lot of people that I've been talking to, some friends and colleagues. They did not do what I would consider to be a full bank bailout. They did not protect the shareholders. They
Correct.
showed management the door. So, the people who should be taking on risk took on the risk. In terms of the depositors, I mean, you could say, oh, why should these, tech companies be saved? But I challenge people to change the name. If it wasn't called Silicon Valley Bank, if it was called the Small Business Bank of Iowa, would you want those small businesses' money to be at risk?
Well, there is a difference in those small businesses, and I'll tell you what the difference is. There's no way in hell this federal government would bail out a small business bank in a red state. I just don't believe it.
That may be the case, but at the same time, if you think about the potential contagion effect, and we can use this now as a benchmark to say they've done it before, that God forbid the small business bank of red state were to fail in the future. But if you think about just the ripple effects, the example I like to use is Etsy. Etsy is a marketplace where artisans and small entrepreneurs do crafts and they sell them. Etsy had all of their working or not all of their working capital, a large portion of their working capital with Silicon Valley Bank. So if that money were to have gone away, they wouldn't have been able to pay all of the entrepreneurs. The same thing with a payroll company. They had their money with Silicon Valley Bank. And so another company wouldn't have been able to pay their entrepreneurs. So that kind of reverberation throughout the system. And then not quelling the fears that this could happen again and potentially taking down not just other regional banks, but having contagions up to big banks. It would have been really bad for everyone. And this.
So wait. I agree with you. I agree with you that it would have been horrendous. Okay. However, I had under the FDIC limit in Silicon Valley Bank for one of my businesses. We ran our payroll through Silicon Valley Bank.
Okay.
We never put more than $250,000 in that. We never do it unless we care to lose it. So why do I have to play by the rules and expect that I'm not going to get something? But all of the big guys will always expect, oh, well, they're going to bail me out. I'm too big to lose. I'm too big to fail.
Yeah, I mean, listen, this is, I think, sort of an expectation sort of game. But the reality is that we didn't want to have that failure happen. And this was a bank that was very different than some of the other failures that had happened before. I mean, this was not about making toxic loans or derivative products. This was really a liquidity issue that should have never gotten to the panic. And I think that's the bigger issue, that the way this was communicated, the hubris. I mean, the fact that the head of Silicon Valley Bank sat on the board of directors of the San Francisco Fed and didn't anticipate that it might not be a good idea to lock up money for 10 years in Treasury. I mean, there are a lot of really weird questions here. And I think we can certainly debate, what we should do on a go-forward basis, but we have to have faith in the banking system, and for companies to take their cash management and now have to go through paperwork and chop it up into little blocks so that they can be covered and have this in all different kinds of banks and all different kinds of accounts isn't particularly efficient. So I think
it's not.
that I think the insurance program probably needs to be relooked at.
But you
and I think that's.
But you can't just write the rules as you go. That's the problem.
They do all the time, Glenn.
I know,
this is not
and
the
it's
first
wrong.
time that they've done it.
And it's wrong to do that.
So fundamentally, it is definitely wrong to do that. But if they're going to continue to do it on an ongoing basis, this was not the time to put the flag down and go, nope, this isn't the time that we should do it. That's just, it was a very sort of practical decision. Yes, in principle, we need to fix the underlying system. But as I said, let's not pretend that we have capitalism here in the United States. You've had the Fed who's been interfering in the market.
It's not capitalism.
From Main Street to Wall Street on a historic basis.
Yeah.
So, I'm not going to sit and pretend, this was, some affront to capitalism that didn't actually exist.
No, the Fed is completely out of control, overstepped, and all of the big banks, the really big banks, they are rolling with our cash, and we're on
rolling in dough.
Yeah,
literally.
So let me go back to the bonds here for a second. They lock these treasuries up for 10 years. And when the interest rates go up, they lost about 25% on their bonds. If they tried to sell them in an emergency, they were going to lose 25 cents on the dollar. That's what caused the panic, because if you lose 25 cents on the dollar, you don't have enough to cover all of the things you have to cover.
Let me add one other thing that added into the panic, because this was on paper. Should they had held them to maturity, there wouldn't have been no problem.
Correct.
Like you said, only in an emergency. What happened is that within Silicon Valley, because interest rates were rising and the bank was only paying a small amount on deposits, you could pull your money out and park it into a treasury bill now and get 5% without very long duration. So you had more depositors pulling their money out than they had modeled and expected in this rising interest rate environment, as well as probably companies that needed more operating cash because of the economy. So they didn't have that expectation, and that sort of mismatch in saying, oh, wait, we have a liquidity need because we didn't estimate for this. That's what forced them to sell the bonds at that loss and then created this panic.
And that's where this boob that is sitting on the Federal Reserve Board in San Francisco, these guys are, I'm convinced these guys are arrogant morons. However, how many other banks have put their money into longer term treasuries?
Oh, I mean, it's throughout the system. Think about.
Wait. Go ahead.
If you take, Bank of America, they also had a situation where they had to take a big loss on selling treasuries. The difference is that they have a large and diversified business. They only had 69% of their liabilities being deposits, where Silicon Valley Bank, it was 89%. They have a lot of retail deposits that were under the threshold. They have investment banking and trading and all these wealth management, all these other things. So for them, it wasn't an issue. But on a smaller scale, for a bank that really does rely on that deposit business, and because they had so much of that as these smaller business deposits that were uninsured, that made it different than it was for, let's say, some of these bigger banks or banks that are structured differently.
Right. So, but I mean, I'm looking at banks like J.P. Morgan Chase, all of the. They're fine. They got plenty of money, and they're going to get all the depositors as the little banks go out.
Exactly.
Right. So
let's underscore that point.
What I'm asking you is, what gives us any indication that this is that it's over, that we're safe now? I mean, it might be because right now, but this is going to happen again.
So that's exactly why they put out the press release that they did, the Fed and the Treasury, and that very comforting statement from our president. I'm sure that gave you all the confidence in the world.
I'm stuffed.
But that was the point, is the reason that those depositors pulled out their deposits is because they were worried it wasn't going to be backstop. And if there was this liquidity issue that was incurred, oh boy, what are we going to do? So yes, there are other banks who are probably in the same situation, but if their customers don't panic and pull their deposits and they have the time to plug that liquidity hole, then that's what that statement was meant to do. Now, it really just depends on the temperament of individuals and businesses. If you believe that, if you believe they're going to step in and backstop, then you're not pulling out the money. These the banks can deal with it. And if you don't, then we're going to see more of this. Certainly, I think, particularly Silicon Valley Bank was different than Silvergate and Signature that had more crypto exposure. I would imagine those that have more exposure to crypto, we're probably going to see some additional issues. But Silicon Valley Bank being that second largest bank to fail in history, one of the top 20 banks in the U.S., systemically important, as you said, obviously plugged in and connected, was just a bit of a different animal.
So
but Glenn, I do want to go to that point that you make, because I think this is really huge. Just like they closed down the small businesses during COVID and all of that went over to the big guys, the big guys couldn't really step in. There's some laws in place about them buying more deposits. But what has happened in letting this play out the way it does is people have just decided to organically move their deposits. So JP Morgan and Citigroup, they're having a field day, so much so that Jamie Dimon just bought something like $26 million worth of JP Morgan stock because he's doubling down, because he knows all of those depositors are rolling in and he did not have to pay a red cent for them.
So as the Fed rate goes up, these treasuries are worth less and less if you have to sell them, correct?
Not to get too wonky, but the interest rates or the yield on the bond trades in inverse to it. And if you think about it, why would you buy a 10-year that was, on the market from a long time ago that's yielding 1 point something percent interest when you can buy something that's at 2 years right now that gives you 5% interest?
Correct.
Doesn't make any sense. So their current value on the market is lower. But again, if you hold them to maturity, if they hold them the 10 years, you still get the full amount of the face value.
Correct.
Plus the interest. It's just the tradable value today in that interim time period because there's not a lot of demand for
right.
that.
So for any small bank that is holding these, if there's trouble, they could be in trouble just like Silicon Valley Bank. Now, the FDIC, we were told, that's the insurance. Yeah. And he said, don't worry, you don't have to worry about it. 'Cause the banks have paid into it. Well, they don't have enough money just to cover what they covered yesterday. So they're already upside down. So that means if we do have runs on the bank in future, near future, they don't have any money, which leads me to believe we will just print the money. The inflation rate of what we're doing is crazy. Is this the beginning of the currency death cycle?
Well, the currency death cycle began a long time ago. I'd say a couple things. So from an FDIC standpoint, they are saying we're going to put a fee out to other banks. So when Joe Biden comes out and says the taxpayer's not paying for this, you're not paying for it directly, but you certainly will be, whether it's a lower interest rate on your money or more
Correct.
Fees or whatnot, if all the other banks have to go in. What I do think can happen here in the meantime is, with the bank, they're trying to sell off pieces of it, and they're trying to find new homes for it. So the FDIC is covering it. It's insurance if it needs to make it whole. But if somebody else were to buy it or to, buy
Right.
other assets, there's a way to, that structure sort of happens. And obviously that's the best case scenario. And again, frankly, we should have just never gotten to the point where we had this panic. But
Right.
The idiots didn't prevail there. Should there be a, God forbid, wide run, yes, then, in terms of trying
Yeah.
to solve this, it would be money
Okay.
printing, which is, again, if I can respond, because, some people did not like what I had to say. That's sort of my point. Someone's saying I'm a paid show. I'm not paid by anybody. I'm saying that we wanted to stem this, because what would happen to everybody, people who were not involved at all, would have cost you a lot more than this, kind of temporary pin here.
I don't think people understand the destruction that is coming our way. It's coming.
Correct.
This is going to happen. It's just a matter of when. And people are like, I'm fine, bring it on. No, you really don't understand. You should be, in a healthy way, terrified of what is coming. And I use the word terrified. Do you remember our grandparents went through something that they were 50 years away from, and they were still like, it could happen at any time. That's the kind of pain that America is about to go through. And remember, those people grew up without indoor toilets, okay? They grew up without all the fancy stuff that we have now. They didn't have that far to fall back. We have an enormous way to go back. You should be terrified of it in a healthy way.